Hello, everyone, and welcome to the Distilled Spirits Council Ask the Expert webinar series. I am Ross Mulcairn, Director of Member Services and Business Development at the Distilled Spirits Council of the United States, better known as DISCUS. Today's topic is pouring over tax reform, what the One Big Beautiful Bill means for the beverage industry with our friends from Blue & Co. We are recording this webinar so that it will be available on the events page of the Discus website, as well as our YouTube channel and in our member portal. Discus is the leading voice and advocate for our members and the distilled spirits industry overall. We provide a wealth of resources and services, including this webinar series, that aims to educate and share relevant trends, ideas, resources, discussions, and opportunities for distillers and everyone in the distilled spirits industry. All of our upcoming webinars can be found at distilledspirits.org/events. I encourage you all to go there and check out what our future Ask the Experts are once we're done today. If you have any questions about resources that Discus can provide or are interested in joining Discus, please reach out to membership@distilledspirits.org. There you can find out about our annual conference next March, the new Craft Edition Liquor Handbook for sale exclusively for Discus members, and so much more. Now, with all that little housekeeping taken care of, I want to welcome today's speakers. We have Patrick Brown, CPA, Director at Blue & Co., and Derek Gray, CPA, Director at Blue & Co., and the two co-founders of Blue Beverage Services. Welcome, gentlemen.
Hey, thanks, Ross.
Thank you, Ross. Great to be here.
So Pat, Derek, and I will talk for about 35, 40 minutes. We will take questions throughout. You can use the little Q&A feature at the bottom of your screen, and then we'll save some time at the end to answer all the questions that we don't get to during the presentation in a set Q&A at the end. Next week, we will send along a link to this webinar recording, along with some slides to help you follow along. Now, let's get started. Thank you both for joining us today to help unpack the One Big Beautiful Bill and what it means for distilleries and the broader beverage industry. Pat, let's start with you. Can you just give us a quick overview, as this is the Ask the Expert series of Blue & Co. and your work in the beverage space that show you guys as our experts today?
Sure, Ross. Thank you. And great to be here. So Blue & Company is a regional accounting firm. We have 13 offices in 5 states: Kentucky, Indiana, Ohio, Michigan, and Tennessee. But we have clients all throughout the United States. So from top to bottom, coast to coast. Our beverage clients are made up of distilleries, wineries, breweries, non-producing distillers, RTD manufacturers, brand owners, barrel funds, barrel brokers, importers, and cooperages, just to name a few. Like a regional accounting firm or an accounting firm, we provide the traditional accounting services. So bookkeeping, financial statements, either audited, reviewed, compiled, to tax compliance for our beverage clients. And then probably where we add more value or the most value is when we get into tax consulting, and then some of our other advisory services. So projections, pro formas, modeling projects. If you're thinking about expanding, or the last couple of years we did a lot for, hey, I'm thinking about building a distillery. What does that mean? So we help put those projections together. We also do some barrel valuations and business valuations for our beverage clients as well. And then throughout the Blue Beverage Services, our existence, we've helped our clients with inventory and inventory costing. So, hey, we produce this juice, whether the juice goes into a barrel to age for a number of years or goes straight into the bottle, what's the cost of that juice? And does it include labor and overhead? And then, in the last, year, maybe 6 months, we've also gotten into excess capacity. So we've slowed down our capacity in our facility for our aging spirit clients. Instead of taking all that labor and overhead and producing a barrel that cost $5,000 with all that excess overhead or excess cost, we help say, okay, this is how much should go to the barrel. This is how much you should expense right away. So making sure the financial statements and what they are holding is accurate. But that's kind of Blue Beverage Services in a nutshell.
That's great. Well, I appreciate you both lending your time as our experts here. Now, What we're here to talk about today is tax reform. I am sitting in our offices in Washington, D.C., and let me tell you, the one big beautiful bill has generated a lot of buzz, a lot of discussion, a lot of opinions, but we're here to talk about the specifics of what happens and how we can deal with it. So, Derek, can you walk us through just like a high-level overview of the legislation and what we'll be covering as part of it today?
Yeah, absolutely. So, Ross, I'm glad you said that, right? Because we are going to be talking about tax policy here. And it is a little bit tough to talk about tax policy without diving into politics, but we're not going to get political here, right? So we might talk about Democrats and Republicans. It's not going to be with any ill will. We're just going to talk about the facts here. So really, it's hard to digest or hard to start unpacking OB3 without first going back to 2017, right? Under President Trump's first administration, there was another, pardon my French here, but big, beautiful bill back then, the Tax Cuts and Jobs Act, that created a lot of tax benefit for American companies, distilleries, individuals, and whatnot. When you do things like drop the corporate tax rate or put into effect certain enhanced deductions, that TCJA, that bill that was passed in 2017, that was passed under a budget reconciliation process, which means that under the Byrd rule, you can only add so much to the federal deficit over a 10-year period. So 2017, we added a whole lot to the federal deficit. Well, some of those provisions were starting to sunset 12/31/25, right? So regardless of what happened, whether President Biden, Vice President Harris, President Trump, regardless of whomever was going to win the election coming into this year, there was always going to be tax reform in 2025 because of all those expiring provisions. So the ones that are probably getting the most play right now as part of this, as part of the tax reform bill, or as part of the tax reform, because this OB3 was part of a broader, total reconciliation package. It had spending provisions in there, Medicare provisions. It seems like, at least in my world, people are talking about taxes the most. And the things that they're talking about the most are the depreciation provisions. There are really three big depreciation provisions that are in there. One is the permanent extension of accelerated bonus depreciation. So bonus depreciation came out back in 2002 in order to stimulate the economy because of the 9/11 attacks, because of Enron, because of all that stuff. And what that does is it allows taxpayers to just accelerate the manner or the speed at which they depreciate assets for federal tax purposes. It's been around, like I said, for more than 20 years in some form or fashion. It started at 30%. It's been 100% and seemingly every number in between 30% and 100%. But beginning as of January 19th, 2025, so Inauguration Day, 2025, for any asset that's placed into service after that, you can write it off immediately if it is non-real property. 179 or code section 179 is simply another provision of the tax code that allows taxpayers to expense non-real property in an accelerated manner. 179 was around before bonus depreciation was, and it's continued since then. It seems to get used less and less every year, particularly in the years where bonus depreciation is at 100%, which is where it is now permanently. So really, I think 179 will continue to get used in very limited circumstances. So, maybe on the state level, or maybe I don't want all of the bonus depreciation. I want to kind of pick and choose what I use. Bonus depreciation on, I might use 179. But the real big one here in terms of depreciation, we've got a new provision out there that deals with qualified production property. Okay, so qualified production property and the rules there allow you to write off the cost of a building. All right, so not equipment, but a building, real property. It allows you to write that off immediately, provided that you meet certain conditions. Okay, the conditions that you have to meet, it's got to be non-residential real property. Okay, so not a permanent, not a residence, not apartment buildings, not multifamily, anything. It's got to be non-residential real property used in a taxpayer's trade or business. Construction has to begin after Inauguration Day 25, and get placed into service, construction has to end before the end of 2028, and that building has to get placed into service before 12/31/2030. Now, the catch here is that that qualified production property needs to be used in manufacturing, production. It's got to be manufacturing related, and there's got to be substantial transformation of the assets that we are manufacturing here. So if I think about it, if I'm making whiskey, if I'm making vodka, if I'm making an RTD, I think I'm probably all right. Where qualified production property is going to get real interesting for our distillery friends are things like bottling. If you think about bottling, is that really substantially transforming a product? If we take it out of a whiskey barrel that's aging in Kentucky and put that into a bottle, is that substantial transformation? What about taking neutral grain spirits out of a tote and adding some flavor to it and then bottling it? Right now, we just don't know yet, right? So we're kind of going based on old case law and what we're reading and going back to the notes from drafting the legislation to try to figure out what's behind that. There will be guidance forthcoming on that, but I think the qualified production property and the depreciation provisions, Ross, they're going to be very helpful to our friends in the spirits industry.
Okay, it is always interesting in the first year of a new tax law as you're trying to sort out all those sort of specifics of what is going to qualify and what is not. But that is interesting, the new qualified production rule. Now, a lot of those things that you were talking about were focusing specifically on depreciation.
Yeah.
Is there anything else in the bill that are sort of outside the depreciation element that our distilleries and our members should be paying attention to?
So Ross, well, it's not new. Code section 1202, which is the sale of qualified small business stock. So this isn't a new thing. It's been around, but what OB3 did was add a few enhancements. So what a qualified business stock is any company or any entity that has post money has a $75 million post money valuation. So we're talking C corps with a post money valuation of 75 million. You can exclude the gain on the sale of that stock up to $15 million or 10 times your basis. So if I have $20 million in basis, I can exclude 20 million times 10 from when I sell that stock. So I said it's been around. Previously, you had to hold the C Corp stock for 5 years. With OB3, now you can exclude up to 50% if you hold it for 3 years, 75% of that gain if you hold it 4 years, and then 100% of up to 15 million or 10 times your basis if you hold it for over 5 years. There are some caveats. The stock has to be acquired directly from the company. So inheriting the stock or buying it from, if I buy the stock from you, Ross, we kind of get into, hey, we need to look at this a little more. But 1202 can be pretty powerful and save some people some tax money on the end.
Yeah, I would agree with you, Pat. I think that's going to be a big one for our friends here in the beverage industry. It used to be that C Corps were kind of a blasé thing that nobody did anymore. But when President Trump and Congress cut the tax rate from 35% to a flat 21% back in 2017 for C corporations, and then you add that benefit on top of that, C Corps, especially if we're building a distillery to sell or building a brand to sell, I think C Corp is starting to look a lot more attractive. I think the other thing that's out there, again, was placed into service in 17, but is now made permanent and part of it, that 199A or the 20% qualified business income deduction that was placed into service in 17 as part of Tax Cuts and Jobs Act, that is here to stay. So for our friends that are not C corporations that have pass-through entities, partnerships, S corporations, those businesses do still get a 20% deduction for all of their manufacturing or all of their qualifying operations. That's out there. That's been made permanent. That'll be a big help also to pass through entities. And then, a lot of it, as we kind of put a bow on some of the business provisions, there are certain things out there you'll recall me saying that the reconciliation bill in 2017, they could only add so much to the federal deficit, right? So you started to have some things, some provisions in there that maybe they weren't quite as business friendly as Republicans are used to doing with tax reform or tax legislation. And you're going to see a number of those in this package as well, because this is also a reconciliation bill. So, things like the limitation on your deductible interest expense, that's been made permanent. Um, the R&E, the research and experimental expenditures, we scored a win there in that those are now they're allowed to be deducted again instead of capitalized. We've got a little bit of shenanigans to deduct all of that stuff that we had capitalized permanently. That changed. There's a handful of other business provisions in there, Ross, but those are kind of the big ones that we're looking at with our clients right now.
Derek, let's not forget the increased reporting requirement for 1099s.
How could I forget that?
Yeah, where before, if you paid a contractor or anybody really more than $600, you had to issue a 1099 to them. Starting in 2026, that the amount you paid to them is increased to $2,000. So makes it a little easier for our corporate friends and what they need to send out from a 1099 perspective.
Okay,
Yes.
so that 1099 threshold really jumped more than 3 times.
Yeah.
Wow.
And yet, I'm going to bet you still have a lot of people saying that it is too low and it's a burden on them. We get it.
Well, I appreciate you bringing that up because something that I have come across as, not a tax accountant here as part of the subject is in the bill, there were a lot of sort of more workforce related provisions, not just on the corporate business tax side. Is there any specifics in that area that we should have our members and our distillers thinking about and focusing on?
Yeah, there's a couple I think that have drawn a lot of publicity, right? There's I'm going to use air quotes here, but no tax on tips and no tax on overtime. And that's not me being a wise guy, right? It's not technically no tax on, you get a deduction on the first 25,000 of tip income that you have as long as you meet certain criteria. So if your income is under $150,000 single or 300,000 if you're married filing joint, if you are in a profession that customarily receives tips, a tour guide, a bartender, a hairdresser, somebody along those lines, then you can exclude the first $25,000 of tips that you receive from your income. I can't, as a tax preparer, because I don't customarily receive tips, say, Ross, the bill for me to prepare your tax return is $25. As long as you give me a $500 tip, that won't play, right? So we've got to be in the business of receiving tips. It's got to be customary. And in fact, I will mention this, and I think you can probably read between the lines there of a little bit of social commentary and using tax to influence social initiatives. But this administration, in order to take advantage of the no tax on tips, you are required to have a social security number. So a taxpayer ID number, a foreign national coming in cannot take advantage of that. You've got to be subject to the Social Security Administration. Similarly, on overtime, the no tax on overtime is really just a deduction for the first $12,500. So exactly half the amount of the no tax on tips. It's exactly half of that. So again, deduction for the first 12,500 of overtime wages that you receive during the year. Again, you would be able to deduct these as a business, whether it's taxable or non-taxable. It's a deduction to the business. But what I think we're going to find here is this is going to be a real nice way for us to maybe incentivize or help some of our employees take advantage of this stuff. I don't know that we've got all of the answers right now. I think the Department of Labor and Congress, or I'm sorry, the IRS have come out and said maybe October-ish, we can start to get a little bit of guidance on how this is going to get reported on W-2s and whatnot. But those two things are very important for the workforce.
Okay. And I do know that there's been a big move within the distillery industry as we're focusing on distillery tourism. A lot of folks are opening up tasting rooms and bars within
Yes.
their facilities. So, one, I know, Pat, I didn't mean to cut you off, but I want to make sure I get in a quick plug for
Sure.
Discus members and available for sale is our new visitor safety guide. If you have a tasting room, Discus now has safety best practices for that space. I encourage everyone to check that out. Discus members have access to that. If you are not a Discus member, you can purchase that. And also, folks who are interested in doing distillery tourism, check out Destination Distillery, which is a free resource that Discus provides to get your distillery listed so that folks can check it out and come visit. Now, Pat, I am very sorry. I did see that I cut you off, but
It's
I got so
it,
excited about those topics. I wanted to talk about them.
it's quite all right, Ross, and that is important. So please go and check out the Discus resources there. I was just going to make 2 points. One is we should make tipping your accountant more prevalent so we can deduct those. But on a serious note, um, Blue and Company is hosting a webinar where we are diving into no tax on tips, no tax on overtime. We're going from the employer perspective. We are joining together with a labor attorney on September 22nd at 11 a.m. So if we have anybody here that is interested in learning more about that, what it means for them, their business, reporting requirements, the information that we know as of September 22nd, we'll show our contact information at the end of this chat, or you can reach out to Ross, and Ross can give you our contact information so we can get you signed up. Or you can go to Blue and Company, Blue and Co. on LinkedIn, and we have the webinar posted there. So one of those places you'll be able to find out more information about no tax on tips and no tax on overtime.
There you go.
Well, I think just one more thing on the workforce implications, because there's a very small part of this, what I'm about to talk about next, will cover or have a workforce implication, but these Trump accounts that have come out, right? So these are the accounts, Ross, that act very much like a Roth IRA, but for minor children. So you can now put away or make a $5,000 contribution into an account, into a Trump account for the benefit of your minor child. That account is not taxable to them. It's not deductible to you as the parent or the guardian of this child. But what happens is the money goes into these accounts, Ross, and it grows tax free until the child takes it out, either when they're 18 or later in life. So it's a way to kind of supercharge for retirement or some other kind of financial goal that these kids have. I bring it up in the workforce because you can make a one-time contribution as a business. You can make a one-time contribution to the account of a minor who works for you or to an employee who has children. So Derek's Distillery LLC could fund a $2,500 contribution to this Trump account for the benefit of Pat's children, for example. So I think that
Wow.
one, I don't know that it's gotten a lot of news yet, but I think as people start to come up and do some year-end planning and meet with their financial advisors and their CPAs, I think those Trump accounts, Ross, are going to be a very, very big part of that planning going forward.
Okay. I can tell you that that one had completely missed my end of year planning and everything that I've covered. But so I'll admit I'm starting to feel like a bit of a broken record, but living here in DC, I know that the whole point of the OB3, with one big beautiful bill, was that everything was going to be covered in it, that they didn't want to pass multiple bills so they could fight over it. They could get every provision they wanted, every tax policy. So we've gone over workforce provisions, we've gone over depreciation and all these other things. Is there anything else left in this giant bill that our distilleries need to be aware of? I feel like we keep talking about all these things, and I something tells me that there's still more.
So I think we've covered what we need for distilleries, but given that we're all individuals, and I'm hoping at least that we all file 1040s, every spring or fall, we probably all file an individual tax return. So there's some stuff in there as well, right, Pat?
Yeah, and not to be a broken record, but from an individual standpoint, OB3 extended or made permanent a number of things from the 2017 Tax Cuts and Jobs Act. So the first, probably the biggest one, is the tax rates. The tax rates were set to reverse back to pre-17 at the end of this year, and those were made permanent. So our highest tax rate is still 37% for those making, just a little bit more than $751,000 a year, married filing joint. So, but what they did do is for the tax rates, they have now made our brackets inflation adjusted. So each year there will be an inflation adjustment where we don't have to wait, 4 or 5, however many additional years for our back brackets to increase or decrease, which I don't know what they will, but don't hold me to it. The other one in the Tax Cuts and Jobs Act was we increased the standard deduction, right? So with OB3, we actually increased it a little bit more. So we made the standard deduction for married filing joint individuals 31,500. Single filers are just half that. And again, that will be adjusted for inflation as well. The mortgage interest deduction, if you have debt of up to $750,000, you can still take a deduction for your mortgage interest. There are some caveats to that and some grandfathered in older loans, but we won't dive too deep into those. But that mortgage interest deduction is sticking around. And then for the child tax credit, it was new. They did increase the per child rate to $202,200 beginning in 2025. It is subject to some income phase out. It will be adjusted for inflation, so it should go up. Very similar to what Derek mentioned before. In order to take advantage of the child tax credit going forward, the child needs a social security number and at least one of the parents needs a social security number. So previously you could get this deduction or get this credit if you had a taxpayer ID number, but now the child and at least one of the parents will need a social security number to take advantage of the child tax credit.
An important flag and change, I'm sure, that'll impact a lot of folks as they're trying to fill out these tax credit policies. Now, we did just get a question in here that I'm hoping you two can help me sort out, which was talking about the depreciation benefits and the tax on tips. Are those clarified or, I guess, stratified by income bracket or size of the business, or do those change at all based on where you're, I guess, how much you're making and how big your business is?
So yeah, let's bonus depreciation for businesses. No, anybody can take advantage of that, all the way from our distillers that are making moonshine in a bathtub, 1 barrel a year, all the way up to the Brown-Formans of the world. Anybody can take advantage of that. Section 179, you've got to meet certain criteria. So you've got to have taxable income. The deduction can't take you to a loss. You can only add so much. So there are some criteria with 179, but not bonus depreciation. In regards to the no tax on tips and no tax on overtime, those are very specifically catered towards those on the lower end of the income spectrum. So I think no tax on tips starts phasing out at 150,000 of adjusted gross income for single filers and 300,000 for married filing joint. And then let me just check my notes here because I think it's close to, but maybe not the same, a little bit more. Yeah, so same phase out limits on the no tax on overtime, 150,000 married filing joint, 300,000 for married filing. I'm sorry, 150 single, 300,000 married filing joint.
Okay, thank you for that. And I will say we're sort of wrapping up the prepared presentation. So if anyone has questions, please submit them. We have a chat, we have a Q&A box. We would love to hear what you guys are interested in. Please utilize our experts while we have them here. I'd love to get some answers for everybody that we have in the chat. So while we wait for people to come in with some more questions for us, I guess, do either of you have any sort of strategic recommendations? I'm not asking you for free work here. I know you guys are CPAs running a business,
We'll
but is
give
there
you some free
anything that
work.
our
Yeah.
distilleries and members, if you have sort of a couple top level items that you think they should take away and at least call their CPA about when they're hanging up after this, ask the expert?
Yeah. So, I mean, I think I would take advantage of all of the depreciation that is out there. I know times are a little bit tough for the industry right now, so maybe we're not placing into service as much as we used to, but certainly take advantage of that depreciation or those depreciation deductions where applicable. But be careful because some of those there are some limitations that are out there, whether it's deductible interest expense or excess business losses. There are certain kind of snakes in the grass that might take what you might think is a deductible interest or a deduction and make it kind of non-deductible or make it lose some of its luster. So absolutely talk to your advisors about that. I think, as Pat mentioned, looking at 1202, particularly if we've got a sale of a business on the horizon, I think that could be very powerful. I think really even something as simple, Ross, as looking at Trump accounts versus like a 529 plan would be very helpful for you. And then finally, I'll revisit your estate plan, right? Because although some of these changes, we didn't talk about them, but there's some pretty powerful estate tax changes that were made permanent also. But what I would tell you, Ross, you know this living in DC, permanent is only permanent until the next election rolls around, right? So take advantage. We've got a great environment to do estate planning, to give amounts away to relatives or friends or your CPA. If you want to give them like 10% of your distillery, do that too. But it's a great environment to do some estate planning. So don't just think, oh, I've got forever to do it because, who knows what's going to happen in 2028.
Okay, good to know. And I will second the ever-changing nature of Washington, D.C., which we love to call home, but the many impacts that that has on everyone all over the country. Actually, to that point, we did have a question in here that I know you and I guess have not talked about too much. We've talked a lot about the One Big Beautiful Bill and its impact on American taxpayers, and especially as various changes are related to Social Security number requirements. Have you guys done a lot of work with foreign producers and with TTB guidelines for foreign producers for control groups and proof gallon assignments?
So, Ross, we have no is the answer. And we have
Okay.
made the pretty conscious decision to stay away from TTB reporting just for the reason that neither Pat nor we're accounting dorks, right? We have never worked in a warehouse or at a distillery and never done a TTB report. And I was not going to be the reason that somebody lost their license because I filled out a TTB report the wrong way. So we have avoided that. I'm sure you've got some friends. We've got some friends. We've got people that we could hook people up with, but we do not work on any TTB kind of consulting.
That's great. And hey, part of the Ask the Experts is knowing what you are expert in and what you are an expert not in. And it is
That's
best
right.
for us to make sure that we are focusing on exactly what we need to be focusing on. Now, we also had another question in here about the extension of the rum cover over in the One Big Beautiful Bill. I am afraid I'm not an expert in that. Is that more your area of expertise with accounting, or is this more TTB?
I'd say that's probably more TTB and legislation. That is not an area that we get into a lot ourselves either.
Okay. Well, then that's good. Well, then let's focus on some more of our more fun tax accounting questions. Um, there was something that you guys mentioned earlier, which was Section 1202, and you talked a lot about C Corp stock and how, it was not necessarily as popular until 2017 with the C Corp tax benefits. Are there parts of this provision that those can that people in our distilleries and members can take advantage of if they are not currently a C Corp?
The answer is you have to be a C Corp to take advantage of Section 1202. Now, can somebody who's in a pass-through entity, an LLC, partnership, S Corp, or sole proprietor switch over to be a C Corp to take advantage of this? The answer is yes, but yes, you can. You can convert over, but I would talk to a tax advisor. I would make sure you understand the repercussions of switching to a C Corp what are we in business to do? Are we in business just to flip it in 5 years? Is this our main source of income? Are we prepared to reinvest all the profits that the company makes back into the company, because any distributions or dividends you get out of a C corp are taxed additionally? So this is one yes, you can switch over. When you do switch, that's when the clock starts. So if you've been in business since 1975 and you switch over to a C corp in 2025, your 5 year or your 3 to 5 year window starts at conversion, not when the original pass through entity was formed back. So yes, but please talk to a tax advisor to have and really think through this conversion, because it's not simple, and unconverting, getting out of the conversion is fairly difficult.
Yeah,
Of
not
course.
for the faint of heart. It can be done, but not for the faint of heart.
All right. Well, thankfully we have you guys here to help advise us, so no one's taking any rash decisions
There
just
you
based
go.
off of today. But I did get another question in here that I'm hoping you guys can speak to. As you talked about depreciation of your facilities that you're growing, a lot of these are ownership based, I assume. Is there any benefit, or are there any provisions for a lot of our distilleries that are leasing some facility space, or they may not own all of their structure, but they are in a larger building where they only have some part of it, or they are only leasing? Is there any benefit to them that they can be taking advantage of?
Yeah, potentially, yes, right. So not under these rules that came out in OB3, but if you go back to 2017, and I mean, talk about broken records, right? Go back to 17. But in 2017, there were some laws there. Qualified improvement property is the phrase that you want to Google or ask your CPA about. So what that does is it allows lessors of property, if they are the ones that are paying for the leasehold improvements there, to be able to count those in certain conditions as 15-year property, which would then allow them to be subject and eligible for bonus depreciation. So yeah, if you are leasing your facility, I would look at that qualified improvement property and see if there's anything that you can do there to take advantage of that amount.
Okay. That's great. Look at you guys. Offering help to everybody, no matter what state they're in. We're trying to help all of our distilleries, right?
Hey Ross, I
Right.
do have an answer for the cover over. So the rum cover over rate was permanently set at $13.25. It was previously broken into two parts: $10.25, which was permanent, and $2.75, which required congressional reauthorization. With the one big beautiful bill, it's now just set at one rate of
Right.
13.25 per proof gallon.
Okay. Thank you very much, Pat. Look at us. We're all getting a little smarter every day, right?
Yes, sir.
I appreciate that. Okay, so gotta say this is a little more self-interested than a distillery. But Derek, there was something you were talking about with your Trump accounts and compared them to a Roth IRA, and you were saying to look at that versus a 529. Now, I'm sure there are some folks on this call who do not own a distillery, but probably have children and are thinking about all this stuff. Is there any specifics to those differences to, sort of how those various options stack up that people should be aware of?
Yeah, I mean they're very similar, right? So the 529s, they did not come out in the one big beautiful bill. They didn't come out in 2017. I'll be darned if I do know when they came out, but they came out some time ago. But think of your 529 plans as kind of a Roth IRA, but when you take those amounts out of the plan, out of a 529 plan, it's got to be used for qualified post-secondary or secondary education expenses. So tuition, books, things like that. If you didn't use it all for oldest child, you could roll it over to the second child. But then if the kid decided to be a pro golfer or go become a WWE wrestler or a computer hacker and didn't go to college, well, that 529 plan, you were going to pay a penalty on taking that money out. The Trump accounts, you do not have any criteria or anything that you have to spend that money on. You just have to, they can take it out when they turn 18 and use it for whatever they want to. A new house, a new wrestling mask, a nice 7-iron, whatever. They can use it for whatever methods they want. So 529 plans, still great. Wonderful tools, but if I can remove some of the restrictions that I've got in a 529 and use that cash however I want to, that Trump account starts to look pretty attractive relative to the 529 plan.
Okay, and I'm taking this that this is official advice that investing in a wrestling mask is a solid financial decision for your children, and that is what you guys encourage?
Make sure, yeah, I am happy to opine on any of those, provenance or jurisdiction or whatever. But yeah, so we can convert that into a deduction, Ross. And if we can't, then Pat can.
Okay.
Most definitely. Most definitely.
That's great. So I would like to open up. I'm coming through the rest of my questions that I've all got. So if anyone else has any questions for our experts, please send them in. We have our chat and our Q&A windows open. We would love to make sure that all of these questions are answered for you while we have everyone here. Um, I will say, Pat, I believe you had something else that you were gonna talk to Derek about. That there was
Yeah.
another question that you had.
Yeah, yes, sir. And I'll just go ahead and throw up our contact information on the screen because I know people after listening about tax policy and new tax policy, they're just going to want to talk to us more, right? So feel free to email either one of us or both of us. Ask us questions, tell us that you actually made it through this presentation and you're still awake. Whatever you may have, happy to hear from anybody on here. And Ross, thank you to you and Discus for hosting this webinar and letting
Cheers.
us kind of to talk about OB3 with you and with members and non-members of Discus. But Derek, you touched on it. You touched on it earlier about the deductibility of auto loan interest, which phases out at fairly low rates, right? Which I think you almost need a $200,000 car loan to maximize the auto loan interest deduction. And that $200,000 car loan would be about the income level of when this phases out. So who can take advantage of this?
Yeah, great question. So for those of you that don't know, there is a little carve out in the bill, and I will leave my commentary to myself. But we'll say that there are certain lobby groups that are very powerful. Real estate, I will go to my deathbed saying real estate has the most powerful lobby in the country. Auto manufacturing is probably not far behind, right? So this is one of those like, wait, really? They passed that kind of things? You can now deduct up to $10,000 of interest on a car loan on your personal tax return. But as Pat mentions, you can that deduction starts phasing out once your adjusted gross income hits 200,000 for married filing joint. And I don't know about you all, but the last time I looked at a new car price tag, that's a big bite at the apple for somebody that's only making, $100,000 a year. Do keep in mind, however, that there are some pretty powerful deductions as part of this law, right? Bonus depreciation, where we might be able to accelerate some non-cash deductions, i.e. depreciation, and take advantage of things like that to artificially reduce our taxable income in a legal manner, but still an artificial manner since it's non-cash. So if you can package your bundle your deductions together and drop your income low enough, I think people like that could do it. Otherwise, Pat, that might be one of those things that plays really well on the election trail and does a lot of great sound bites, but doesn't end up getting a whole lot of use in terms of that piece of legislation.
Understood. Thanks, Derek. What about staying with deductions, state and local tax deduction? That itemized deduction was significantly reduced in the 2017 TCJA. Did OB3 change anything with that? And
Yeah, it did. So that deduction, when that went into effect in 2017, almost automatically, everybody along the eastern seaboard and California raised their hands, right? They were in the real high tax states that they were the ones taking advantage of that deduction on their Schedule A. That deduction, the state local tax deduction, has been raised from a cap of $10,000 to a cap of $40,000. So 4x, but there's an income phase out. So really, once you're in between 500,000 and like 700,000, that amount starts to phase out and gets closer and closer to that $10,000 that came into play in 2017. It does not, however, OB3 have any impact on PTET or any of the other workarounds that the states have done. The federal government has pretty much just tossed in the towel on that one and said, we are not going to try to fight that or change that or anything. So if you are in a state with a pass-through entity tax and you are taking advantage of that, I do not expect that to go away anytime soon.
Awesome. And then Derek, you mentioned some uncertainty or some clarity that would be coming out sometime. I think you mentioned October for no tax on tips and no tax on overtime. But there are some questions around or some uncertainty around qualified production property. Also, you didn't mention it, but how are these Trump accounts really going to work? How are we going to track it? All of that good stuff that we just kick the can and we'll worry about later. But at some point, we're going to have to worry about it. When are we going to get clarity on what this stuff means? What are the provisions? What are the true rules behind some of these items?
Yeah, if I would say Pat will have all of the answers for you by the 30th of this month. So just call him. Pat, I wish I had an answer for you. I don't. Other than probably sometime in the future, hopefully before we have to file next year's returns, but don't hold your breath, right? So I think we're going to see this come in waves, right? You'll see some of it this fall as form instructions come out. We'll get a little bit of clarity there. Maybe Congress passes a bill or their Treasury drafts a regulation. At some point, I think a lot of the answers are going to come out in late fall, early spring as we ramp up towards the calendar year 2026 filing season. I will say, though, that, if you look at some of these previous law changes, particularly those that are coming about in relation to a Reconciliation Act, because under that Reconciliation Act, and this is not just a Republican thing, they passed that without nary a Democratic vote, just like the Democrats passed it with nary a Republican vote back in 2012. And, so this is it's not a partisan issue. But if you think then that the Democrats are going to hop back in and help craft a bill to help the Republicans fix some of this stuff that they did without a Democratic vote, that doesn't usually work out so well. So I think a lot of it, we're going to get guidance in the next 6 to 9 months. There could be some of it that gets held hostage and maybe we don't get a fix on for 12 to 18 months.
And I haven't seen any other questions come in, Ross. I don't know if you have, but I have one more question for Derek, if you don't.
Go on ahead.
So Derek, I don't know if I dreamt this. I don't know if what I clicked on to have, to learn about this. But at Blue and Company, especially Blue and Company here in Louisville, Kentucky, we have a pretty robust snack closet. Right. I want to say that we're generous to our employees with this snack closet. But the rumor was that I saw was OB3 is terminating the deductibility of snacks. Please tell me that was a bad dream or set me straight so we can do something about this before the end of the year.
Not bad dream, Pat, just bad information, right? So It unfortunately is true, although misidentified, right? So that was actually part of the 2017 Tax Cuts and Jobs Act. But it was one of those things that didn't take into effect, even though it passed in 17, it didn't take into effect until 12/31/25. I think everybody kind of forgot about it. And then when OB3, Pat, started really gaining some momentum, people were hopeful that that was going to get killed. It did not get killed. how much revenue they think it's going to raise. I mean, we're talking about billions here that they think is going to get raised. Call me dubious in backing up that belief. I don't think that it's really going to change anybody's behavior, but that's just me. So load up your cars, take a big trip to Sam's or Costco in December because yeah, your stacks are technically non-deductible after that.
Okay. Well, I appreciate both of you and all of your insight on obviously business deductions and snack deductions, both equally important to everyone here on this call.
Amen.
But I will just say thank you again, Derek and Patrick, for showing up here, for answering all of our questions for our members. If anyone has any other questions, please reach out to membership@distilledspirits.org. You saw Patrick and Derek's contact information there, so you can reach out to them as well. If you need anything at all, please reach us at Discus. We appreciate having you all here. We will have more of these Ask the Experts coming up. They are going to be mostly on Thursdays. We are having a special edition today on Tuesday, but you will get this webinar sent out to all of you who registered. You can check this out on the member portal. If you do not have access to your member portal, please reach out to us and we will get you set up and we will get you access to all this information. So thanks everybody for being here. Hope you all got some wonderful answers to your questions and know so much more about snack tax law and hopefully some distillery information as well. So we will see you all in the future. Thank you all for joining us. Have a good day.
Thank you all.
Thank you, Ross.